Hello. Today we'll be talking about the future of lending industry and the type of financing that we have in the current market. To give you a brief introduction about myself, I am Dhairya Patel. I am based out of Ahmedabad, India, and I have been in the financing industry for quite long. So I have some lenders who have a particular kind of solution. And to talk about the same, let's discuss the agenda that we have for today. So we will be discussing about the type of financing we have in the market, debt versus equity, which you would prefer as a borrower. What do lenders think when they want to provide you the loan? The terminology of financing and some examples model. We'll go through it. Now, we'll be starting first with debt versus equity. So what is the main aspect that you would think about the same? The factors that determine financing are types of asset, owner's preference for debt of equity, whether you prefer which kind of financing, the company size and its maturity, and the firm's economic potential. Now, when we go further into it, what are the trade-offs between debt and equity? So the main three are potential profitability, financial risk, and voting control. When we talk about one by one, in debt, you have more voting control as you have taken the debt and you would have to repay the same. In financial risk too, debt has a higher financial risk and equity has a lower financial risk. And if you look at the potential profitability, obviously all your company shares are owned by you, so you would have the maximum and the highest return on investment if you take the debt financing. Moving further to it, what all are the lending solutions or the lenders in the market who provide equity and debt? So let's say if you are starting the business, you would be starting it from the personal saving. So that is a part of equity. You can take loan or ask your friends and family to invest in your business. And also there are other individual investors. So they can both provide equity as well as debt. Now there are commercial banks, asset-based lenders, government-sponsored programs, business suppliers, and community-based financial institutions. These are all the lending organizations which only provide the debt financing, no equity financing. But also there are venture capital firms and large corporations which would prefer equity as well as debt. And the final is the public sale of stocks, that is after IPO, initial public offering. So that comes to the equity part, that you liquidate your share in the market and then you go for the equity outreach. Now, when we talk about what exactly does the lender sees while providing the financing, so there are major five C's of credit that lender sees. The first one is character. So based on character, lender looks after the financial history and the credit score or credit history of the borrower. Then comes capacity, your ability to repay the loan or your business ability to generate the revenue to repay the loan. Then there is capital. What are the assets of your business? That can include machinery, equipments, inventory, or land, which can be the capital which would help you getting the loan or financing. Then comes the condition of the industry and economy. We know that during pandemic or the current COVID times, tech industry was booming. But if we talk other industries like let's say manufacturing, that was quite on hold. So it all depends on the inflation recovery, whether the economy is developing or stable economy. So these are the condition of the industries. And the last C is collateral. What is the cash or asset that you can pledge or put as a collateral to secure a loan? It's basically for the risk mitigation. If the financing is having a collateral, you would get quite good rates for financing. So these are the major or five C's of credit. Now, what are the bankers or lenders concerned when they are providing you the money? We'll think it from lender's perspective. So first question they have is how much money is needed by the borrower and when? Then what is venture going to do with the money? So they would like to look at your business plan. Now, how much will we earn from the loan? So bankers or lenders themselves can earn from the loan. And when and how will the money be paid back? So these are the major concerns that a banker has. Now let's look at the other questions that lender asks while providing you the loan. What exactly is the purpose and the amount of loan borrower is seeking, and does it make sense both for the bank and also for the borrower? Now, does the borrower has a strong character and reasonable ability to pay back the loan? Does the loan have a primary source of repayment? Does it have secondary source of repayment if primary fails? Can the loan be priced profitably both for the borrower and also for the lender? So to develop a good customer relationship with the bank and the borrower. Now also, can the loan be properly structured and documented if the loan is variable terms and conditions? Now when we move forward, so there are basically four main classification of loans that can be provided. The first is open-ended. What does open-ended mean? So let's say you are provided $10 million for a span of 10 years. So you can use $5 million from it. You repay 5 million. So now your credit limit again reaches to $10 million. So you can borrow again and again from that fund. So the best example of it is credit card or line of credit. So each time you make purchase, your available credit decreases, and on payment it increases back. So that's open-ended. And exactly opposite is the close-ended one. So it cannot be borrowed once it is repaid. So it's like an auto loan, mortgage loan, or student loan. You take the loan, once you repay it, you can't take the money back from it. So basically, it is the balance of the loan goes down as you pay back the loan. Now there are other two classifications. The first is secured loan. So secured loan is the one where you keep some collateral. Let's say the collateral can be land, inventory, or anything else, and it helps you lower the interest rate or the terms of the loan that you have. And in case of if you default, if the borrower defaults the loan, the lender takes the possession of the asset that you kept as a collateral. And when we talk about unsecured loan, there is no collateral involved, and so it is higher risk, hence higher interest. And if you default on the loan, the lender has to go through the lawsuits or other debt collection methods. So these are the general classifications of loan. Now there are some basic terminology that you should know while taking equity or debt financing. The first is interest rate. There are four different types of interest rate. The first is primary rate. This is the rate which commercial banks charge to its most credit-worthy customers. Then second is the LIBOR, London Interbank Offered Rate. The London banks offer to other London banks. The third is fixed interest rate. So let's say you took a loan for 10 years. The interest rate would not change, and it doesn't depend on the economy or inflation or anything else. The rate remains the same. And the fourth one is floating rate. So this rate varies with the change in the prime rate. Now, those were the terminology for interest rate. When we come to the term, there is loan maturity date. So it defines for what period of time have you taken the loan. So it's maturity date matched to use the fund. Second is repayment schedule. So it can be equal or decreasing monthly, quarterly, or annual payment. So it can be, let's say, $10,000 every month, or it can be like $10,000 for the first month, $9,500 for next month, 9,000 the month after that. So it can be both methods. And the third one is loan covenants. So it basically implies the bank impose restrictions on the borrower. So it all depends on the financial statements. If they make any loan use restriction that the loan can only be used for, let's say, financing of your home or buying these equipments, and you can't use it for any other purpose. Also, it can be equity requirements or personal guarantees. So these are the general terms when it comes to the financing part. Now, when we go further down the line, what are the types of lenders? So there can be fixed terms and condition. So lenders have that, let's say that they provide 8% interest rate for 5 years, and this is that fixed interest rate. If your business model matches that, they provide the financing. The second is variable terms and condition, in which they first analyze your whole business. They look at it that how exactly or how good the business model is, and then they provide you the rate that can be offered on your business case or the collateral you have. So that's variable terms and condition. And when it comes to fees, there are majorly three fees: upfront fee, due diligence cost, and success fee. So Some lenders charge the upfront fees, which are non-refundable for starting the process, which would include the cost that they have to bear. Second is the due diligence cost. So the cost required to analyze your business, that if your business is legit, the survey that you provided or the growth that you provided for the future, is it valid or not? They do the very thorough due diligence process, and there is a due diligence cost involved in the same. And then there is a success fee. So in success fee, it's charged when the loan is successfully provided to you or the equity financing successfully provided to you. So now this all three costs depends from lender to lender. Some only charges success fee, some charges all the three fees. So as I say, it depends from lender to lender. Now moving further, we would start with some of the examples of the lender. So first we'll discuss about the stock loans. Now let's take an example. Let's consider three, A, B, and C. Let's name it as Iron Man, Batman, and Wonder Woman. So now, what exactly do we have for all of this? So they own stocks in a public company. The stocks are bright stocks and they have good prospect. Now they want to keep their stocks, but they also want to take a loan out of it, and they want to gain the capital appreciation out of it and the benefits from the dividends of the stock that they own. The stock owners want to raise cash. They are in need of instant money, let's say for any particular aspect. The Batman needs it for investing back into the stock market. Iron Man needs it for buying a real estate property, and Wonder Woman needs it for starting a new business. But what exactly they can do is, they don't want to sell the stock, but they also have immediate cash needs. How exactly can we solve this situation? Now, these are the things that general lenders ask. Put any of their asset online. So that means collateral. They see after the tax returns. They want credit history to be checked. They want projections, appraisals, and business plans. But they do not want to show any of this. So there is a specific program for the same. Now, these stock loans are non-recourse in nature. What non-recourse means is that lender cannot go after the other assets. The only collateral is the stock that they have kept as a collateral. There is no need to give any other personal guarantee. So there is no personal guarantee. And also there is no upfront fees involved. So as I mentioned in the fees, only success fee is the aspect that is involved in this kind of loans. Also, this type of loans are non-title transfer. So the stocks are in the name of the borrower and they are not transferred to the name of the lender. So, well, if you see the terms, they are one of the best. The only requirement of the stock is they should be listed on most of the world exchanges or the major world exchanges across the world. They should be freely trading, non-restricted, and the daily minimum trading volume should be of more than 30,000 US dollars. If it matches the criteria, then the lender can see that if they can provide the loan on this aspect. Now, if we talk about the terms of loan, it can be nearly 70% LTV, loan to value. It can be for 3 to 10 years, and it has fixed quarterly interest payments, as we discussed about different modes of interest payment. Also, there can be a different payment option. So this lender is the private one. So let's say that if you have taken the loan at the end for 5 years, at the end of 5 years, if you are not able to pay back the loan, you can go on negotiating with other terms with the lender and can take the loan for further period. Also, this loan can be completed within the period of 2 weeks, right from the first introduction call. And the minimum loan for this aspect is 50,000 USD. The loans are provided only about this. Now, the lender knows that borrower wants a crisp, efficient, timely process, and also they want to maintain privacy and confidentiality of the borrower. So they provide this loan with all these aspects taken into account. Now the borrower can get this cash and they can use it for any purpose. They does not have any loan covenants out of it, and they do not have to risk any other assets. So this is one of the best stock loans that one can get in the market. And then we'll talk about another program, that is unsecured business line of credit. Now, what are these loans or what is this model? So let's look at some of the terms that this borrower has. So they provide this for the 5% interest rate for 5 years. So as you see, it's unsecured. So there is no collateral involved in it. Also, there are no prepayment penalties. So if you are able to pay the loan earlier in the time, there are no payments that lender applies on the borrower. Also, there is no personal guarantee, no personal credit reports are pulled, no restrictions on use of fund, no sourcing or seasoning of funds for the escrow account, no monthly payment dues, and property ownership is also not required. But these loans are only for the corporate. These are not for the personal use. They can only use it for their business process. Now, the loan amount is limited by the executive summary and the exit strategy. So, if the borrower is applying for this loan, they need to provide a very good business plan that makes sense, and the lender can see that it would be able to generate primary and the secondary source of income, so that you can pay back the loan to the lender. Now, this loan is best for the startups and small businesses. Why? Let's look at one of the example and how exactly this loan works. So let's say you are a borrower and you want to develop $10 million. Now you go to a lender and you say that I need a $10 million loan. So now this includes upfront cost. So first you provide them their business model and all. And once they look at the business model, they see that they can provide loan. Then they charge you the upfront cost of 6,900 USD. Now, once those are charged, we know that the term of the loan is 5% for 5 years. So the total interest payment is 2.5 million USD. Now, lender, because they do not look after any other assets, they want this $2.5 million to be paid upfront in the escrow account, so that this payment will be utilized for the interest payment from the escrow account. So you as a borrower would need to deposit $2.5 million to a escrow account. Now, let's say you don't have that money and you don't want to invest this money. What you can do is you can go to a lender too, and you can ask them to provide you a loan of $2.5 million, which can be kept in the escrow account, and the interest payments would be made to the lender one from that escrow account. But now, as you are going to lender two would do a due diligence on you and would obviously take a due diligence cost of nearly 10 to 25,000 USD. And once that is done, the amount is transferred to the escrow account. Now, let's say there are many calculations included in this. And after all this process, if you seek for the loan of $10 million, the money you will get in hand is only around $6 million. So now how exactly this can work if you are seeking for $10 million? So you should go ahead with taking the loan for 16 million USD if you want to receive 10 million USD. Now, with this lender, they pay the loan in 4 tranches. The first draw is of $6 million. So as we know that out of $16 million, 5% for 5 years is 25%. So the 25% will be paid as a interest. So it comes down to $4 million. So the first tranche or the first draw is provided to you within 14 to 100 days after the second lender puts money in the escrow account. So generally this 6 million goes into providing 4 million to the lender one and all the other fees and all the other costs. So basically you do not receive any good money from this tranche. But then there are second, third and fourth draw of 4 million, 4 million and 2 million respectively, which comes on 45 to 60 days after the last draw. So now this is $10 million. This will come directly to your account and this will be used, and this you can use for your own business. And basically this solution is made, or this technique is made, so that you have no other payments for the next 5 years. So there is no interest payments, and only payment left is the balloon payment of $16 million at the end of 5 years. Now, why did I say that it is good for small businesses or startups? Because when you are quite a small business, you can't go to a bank asking for a $10 million loan because you do not have that good financial statements or good statements on your books. So you can take this loan, and as you have taken this loan, you would have worked for 5 years, and now you would have very good statements on your book or very good numbers on your book. And now if you want, you can go to a regional bank or a local bank to get a loan at the end of 5 years if you don't have money to make the balloon payment. and you can go on further with taking the loan at that aspect. So this is a special model made for startups and small businesses. So this is one of the model that I wanted to mention you about. Now, what is the general process which goes on while equity or debt financing? So the first is the introductory or exploratory call, where the lender or I understand your exact requirement. Then there is a loan submission that, yeah, I would like to take the loan. And the letter of intent and term sheet would be provided. These are the general terms on which we'll be providing you the loan on. Once you accept those, there will be a thorough due diligence done on you and your business to know that everything you have mentioned during the loan submission period is right, it's correct, and there is no fraud or anti-money laundering involved in the same. And then it once the due diligence is done, the process moves forward with the loan documents. So the loan documents is issued to the borrower. You review the loan document and then you sign it. And after signing the loan document, if any collateral is required, that is kept in the custodian account or escrow account. And then the loan is funded in, let's say, one shot lump sum payment or tranches, whichever seems feasible as per the particular situation. So this is the general process or the general loan process that applies in the lending market. And when we talk about the equity investors, what are those? So the first is business angels, so private individuals who invest in other entrepreneurial ventures. Then there are VC firms, venture capital firms. So these are the funds which are provided by wealthy private individuals, though those can be business angels, to the high risk ventures. And then there is private equity. So private equity forms limited partnership that buys your business, restructure companies, takes them to the profit, and then they can sell the further business to a newer company. And they basically raise fund from the large institutional investors. So these are some of the equity investors that are in the market. Now, when we talk about the financing that we have done in the market, we have done this loans and financing all across the world, right from North, South America, Asia, Africa, Australia. So this can be done all over the world. We can have an introductory call and exactly discuss what a requirement is, and if it fits, we can definitely go further with those aspects. So I guess you might have learned a bit more from this presentation. So you can definitely talk to us today, and thank you for allowing me to present to you. I hope it makes better sense. And if you want to reach out to me, you can reach out to me via LinkedIn, via mail. My mail ID is dhiryapatel 006 @gmail.com. Dhiryapatel 006 @gmail.com. You can reach out to me by WhatsApp or Skype. I guess it makes sense. So thank you so much for listening.